right, today we're basically going to be detectives. We're going to crack open this technical analysis of the Sensex and really figure out how the analyst went from, feeling pretty good about things to a completely negative verdict. So let's dive in. Okay, so everything we need, it's all right here on this one slide. I know, it looks like a whole lot of noise, right? But trust me, there's a story in there told with data. And our job is to basically follow the breadcrumbs the analysts left behind and see how they got to their final conclusion. So, what was the final call? Well, it's pretty blunt. Negative. That's it. But in any good detective story, knowing what happened is just the start. The really interesting part is the why. So let's start digging into the evidence they used to get there. And here's the thing. Like any good story, this one's got a twist. You'd think with a negative verdict, it would start out looking bad, right? Nope. It actually begins on a surprisingly positive note. So let's kind of set the scene. So the first thing the analyst points out is this. The Sensex is in what they call a rising trend channel. Now, in simple terms, all that really means is that the market was basically heading up. It was on a nice, steady upward path, which usually signals that, hey, investors are feeling pretty confident. So let's break that down a little more. What exactly is a rising trend channel? The best way to picture it is like an upward sloping hallway for the stock price. You've got a floor and a ceiling, and as long as the price is just bouncing along nicely inside that hallway, heading up, everything looks good. It's a sign of a healthy, positive market. And you can literally see that hallway right here on the chart. See that? The market looked really strong, just chugging along, moving upwards. Everything seemed fine. But, and this is a big but, the analysts spotted something, a tiny clue that was about to flip this whole story on its head. Okay, so here it is, the plot twist. This is the clue, the one piece of evidence that suggested this whole optimistic story might be about to take a very different, much darker turn. And that clue has a name. It's called a double top formation. Now, what the heck is that? Just imagine a mountain climber, right? They struggle to get to the summit, they make it, then they come down a bit for a rest. When they try to go back up, they just can't make it to that same peak again. They run out of steam. That's a double top. It's a classic sign that the upward energy is just gone. And look, you can see it right there on the chart. See how the index goes up, hits a high, pulls back a bit, and then tries to go up again but just can't get there? It forms this kind of M shape. For an analyst, seeing that pattern is a huge red flag. It's the first real warning sign.
But, okay, one clue isn't enough to convict, right? A good detective needs corroborating evidence. The analyst needed more proof, to be sure. And they found it when the index started to do something very worrying. It started breaking through key support levels.
So to get what that means, we got to talk about support. The absolute easiest way to think about a support level is to just picture a floor. It's a price level that, historically, has held up. It's where a bunch of buyers tend to jump in and say, nope, not going any lower, and they prop the price up. It's kind of like a safety net.
Now, in this case, the analyst zeroed in on the 84,000 mark. That was the critical floor. You could call it the line in the sand. This was the level that absolutely needed to hold strong. And so the big question became, will it?
And the answer was a big fat no. It all happened in steps. First, you have the double top whispering that there might be trouble. Then, the price cracks through an initial weaker support level. And then, bam, the final blow. The index just smashes right through that critical 84,000 floor. At that point, for the analyst, the case was pretty much closed.
Okay, so the negative trend seems confirmed. The floor has been broken. So now what? What does the analyst predict is going to happen next? Let's take a look at the actual forecast. Unsurprisingly, the prediction is for things to keep heading down. But here's the really interesting part. Another little twist. The analysis says that if the price tries to bounce back up, it's now going to hit a wall, what they call resistance, at that exact same 84,000 level. It's really simple. If support was the floor holding the price up, then resistance is the ceiling pushing the price down. It's a price point where the index has a really hard time breaking through to the upside, because that's where sellers usually step in and start pushing it back down again. And this, right here, is probably the most important takeaway from the whole thing. That 84,000 level did a complete role reversal. The thing that used to be the floor is now the new ceiling. It's a textbook pattern in technical analysis, and it's literally called support becomes resistance. Now, it's also really important to remember the time frame here.
This negative forecast isn't for, the next 10 years. The analyst is specifically talking about the medium term, which they define as the next 1 to 6 months.
Okay, so let's recap our little investigation real quick. We started with what looked like a healthy, optimistic market. Then our first clue, that double top, showed up and warned us something was wrong. That suspicion was confirmed when the price broke right through its support floor. And the final verdict? A negative forecast, with that old floor now becoming the new ceiling.
So there you have it, a really fascinating case study built entirely on spotting patterns in past behavior to predict what might happen next. But of course, that leaves us with the million-dollar question, doesn't it? Can looking at the past ever really tell us what's going to happen in the future? That's definitely something to think about.